You are what you do. You can say any amount of things that you want to say, but what you do is what everybody sees.
People are like, oh, I'm just going to JV it. Like, let's just JV it. Like, what the hell does that mean?
I cannot tell you how excited I am to hang out with you guys today, so thank you so much.
Well, then that end buyer could come back and say, well, I didn't fully understand that it was subject to.
That's not a thing. Like, the SEC has thought of all of these things. They've been here since 1932.
And you can do what you want with your property.
Buyers have time, they have negotiating power, they have options.
Oh my gosh, I am blown away by your inexperience, and they've been in business 20 years.
And that includes things other people put on your property, right? It's your property. It'll be okay. Suddenly, cousin Jimmy's in a lawsuit.
A novation is replacing one contract or one obligation with another.
Out with the old, in with the new.
Yes.
Hey, everybody, welcome to the show. Today, we're talking about the 1031 exchange. I'm Andy Fowler, and I'm here with Sean St. Clair. If you're new to the show, make sure to like our channels. You can find us on Facebook. You can find us on Twitter, now known as X, and you can find us on YouTube. On YouTube, we are at INREM Podcast. That is at INREM Podcast. Also, you can find the audio version of our podcast in YouTube. We have an audio version there, as well as Spotify and as well as on Apple Podcasts. It helps us a ton if you go there right now, leave a review, leave any comment, and download the podcast. We'd really appreciate it. With that, we're going to go to Sean, who has our legal update.
Thank you, Andy. So today's legal update is discussing what a substitution of collateral clause is and when you should use it. So what is a substitution of collateral clause? Well, a substitution of collateral clause is a clause that is placed into loan documents that basically states that the borrower has a right to substitute collateral for the repayment of the loan. And so what that means is the borrower has the ability to go to the lender and say, okay, look, lender, I know you have this deed of trust or mortgage against this one piece of real estate. However, I either want to refinance or sell this piece of real estate that you have a lien against. So I'm going to move your lien or your mortgage or and deed of trust over to this other piece of real estate. Now, there are going to be provisions in the substitution of collateral clause that requires that the other piece of real estate have a set loan to value ratio. So if you're going to move it over, the lender wants to make sure that they're going to be equally protected using this property as opposed to the property that they started with. But assuming that the loan to value ratio is met, then you can go to the lender, and the lender is required, if you have a properly drafted substitution of collateral clause, to basically accept and move their security interest or their lien, mortgage, deed of trust, whatever the case may be, to move it to the new property. Now, when would you use a substitution of collateral? What's the purpose? So one could be that you did seller financing and to purchase the property, but now you're ready to do improvements or construction on the property, and you need to go and obtain a construction loan. And maybe your construction lender is saying, I don't want to be in second position on this property, or there's not enough equity in this property to secure my construction loan. So then you would, if you had another piece or a substitute piece of property, you could move the seller's loan to that property. So that frees up the original property for you to obtain that construction loan. Or maybe the original property has appreciated and you want to do maybe a 1031 exchange, similar to what we're going to talk about today, but you have another piece of property that you just acquired. You haven't seen the appreciation like you did on the other property, but it's free and clear, or there's, the LTV meets the requirements. You could then move that loan against that property, freeing up the other property to be sold without paying off the loan that is outstanding to the seller. And then you can sell it and say, do a 1031 exchange or utilize the proceeds for whatever purposes you have in mind. And That's basically substitution of collateral clause. It's a clause that allows you as the borrower to move the mortgage and deed of trust from one property to another so that you could obtain financing on the original property, or you could even sell the original property without having to pay off the loan.
Sean, a question for you. In a typical set of loan documents, what is the default? What are you seeing is usually going to be the default? In other words, if you do nothing, what could you typically expect for it to either allow it or prohibit it?
It won't have a substitution of collateral clause, which means it's now up to you to go and negotiate with the lender, but the lender would have no legal obligation or requirement to remove or move their collateral from one property to another. So that's the default, is no substitution of collateral clause. Obviously, if you're going to put one in the loan documents, since it's not the default and it's a unique clause, you're going to want something signed by the seller, because a promissory note is a unilateral document. It's not signed by the lender generally, nor is the deed of trust. So if those documents have substitution of collateral clauses, you don't want the lender to come back and say, oh, you tricked me. You threw that in there. I didn't even know it existed because I didn't sign the document. So you're going to want to make sure that, before you go down this path, that you have a conversation with the seller or with the lender and say, okay, we're going to put this clause in here. Here's what that looks like. And we need your initials here saying that you understand that there's going to be this, substitution of collateral clause. In fact, I would probably even word for word put in the exact language of the substitution of collateral clause and have the seller or the lender initial it, so that you have an acknowledgement that, hey, yeah, the loan documents are going to obtain this clause. I'm agreeable to it, and I will substitute or allow the substitution of collateral if that time ever comes.
And I would think this is really not only for somebody with lots of properties. Obviously, you need to have other collateral in order to substitute. But if you were wanting to think kind of at the beginning of your investment career on what I would like the ability to have to do, because a lot of these loan terms are lengthy and you might be dealing with something long. So if you want that ability or see that you might use it in the future as you acquire more investment properties, it's really going to be on you to negotiate that.
Yeah, that's something that should be negotiated on the front end. And it's a complex, basically kind of an advanced provision that investors would use. But, investors that are experienced and know what they're doing, they're probably going to like having a clause like that in their loan documents.
Yeah, for sure. All right, let's talk about a few events coming up for you, the listener, and here at the INREM podcast. So tomorrow, 5 p.m., every Wednesday at 5 p.m., the Creative Finance Collective. What is that briefly? That is a group, a club, so to speak, of professionals in the creative finance space, professionals from a variety of different areas and jurisdictions that did get together weekly to discuss creative finance. I know we talked just last week about the substitution of collateral provision that Sean was talking about here. And we discussed it back and forth with 5 or 6 of us. And the neat thing about the Creative Finance Collective, it provides you, the listener, the opportunity to ask questions for the entire hour. Really, we just make ourselves available to talk about creative finance and answer your questions. And if you don't have questions, then we're going to talk about football or something else, or maybe creative financing. But we're here for you, so take advantage of it. Be there 5 p.m. Arizona time every Wednesday. It's live. You can find it on Facebook, YouTube, and Twitter. We're there to answer your questions, so make sure to join us. Also, we're taking questions in the final 15 minutes of today's episode. So how can you participate in that? So as you think of a question, go ahead and post it in the chat. We're monitoring the chats of all the different platforms. So if you have a question, go ahead and post it there and we'll read it. Don't wait till the end to just come up with your questions. If you're like me, you will have forgotten about it well in advance of that. So go ahead and post it as they come. We'll take note of it and we'll be prepared to answer your questions. With that, let's get into our topic today. So we're talking about taxes and the 1031 exchange. You've all heard about it. And if you're like me or a lot of us, you think you know a little bit about it and then find out you almost know nothing about it. It's a complex transaction, but one that's often talked about. And to discuss the 1031 exchange, we have with us the CPA attorney, Todd Lenczycki. Todd, thank you so much for joining us. How are you?
I'm doing excellent. Thank you, gentlemen, for having me on, and I appreciate being here.
Yeah, so as the CPA attorney, that should tell folks a little bit about your background. Todd, if you've watched our show regularly, know that he's been on the show and a great source of information. But Todd, why don't you give our listeners a little bit about your background, how you got into doing what you do?
Yeah, absolutely. The first thing I want to say, though, is the collective on Wednesday. I've actually watched a few of those shows. They're excellent. I recommend everyone getting on there, especially if you're in the creative financing world. So about myself.
Well, you should jump on.
I have in the past. I'm not smart enough to be on your guys' level just
I don't
yet.
know
So
about
I'm more
that.
of a listener as opposed to a contributor right now, but I'll be there. Trust me.
All right.
So about myself, my name is Todd Lenczycki. I've been an attorney now for about 15 years. I've been a CPA for longer. That's kind of my niche. I started off going to accounting school at Arizona State University. I got my degree there. I did external audits for publicly traded companies. I have a great grasp of anything from bookkeeping up to SEC laws. That's kind of what I was doing. I decided to go to law school again at Arizona State University, and best decision I ever made. I love being an attorney. I love helping people out. I am a litigator. I have processed many cases through trial or arbitrations, but I also have a transactional side to my business. So I handle real estate transactions, seems to be a predominant thing I've been working on lately, but I'm also able to do contracts, those kind of things, whatever finance and law meets, hopefully I'm there helping you out. That's kind of what I would like to do. My practice itself, I'm licensed in Arizona and in California. So I handle a lot of clients out in California as well. I am based in Southern California, kind of near San Diego, but I can handle anything up north as far as San Francisco or even farther north or inland. So I'm more than happy to help out anyone with California issues if you get outside of Arizona. A little bit more about myself. I've been running my own firm now for over a year, the CPAattorney.com. You can look me up online and get a hold of me that way. Also, my email address and phone number is on there as well.
So you were a CPA first before you were an attorney. So Todd, did you have a light bulb moment where where that animated or triggered your decision to say, I got to shift from being a CPA to being an attorney? What was that?
Exactly. I grew up watching legal shows. I grew up watching.
It was Hollywood.
Yeah, exactly. In court. And I was like, I think I can do that. That seems like something that would make my day go by faster, allow me to meet more people, allow me to have a more enjoyable work life. Not that accounting was not enjoyable, but it was more time behind a desk working, with spreadsheets and documents. And I'm more of a people person, I think. So I took the LSAT. I love Arizona State University, as people know. Go Sun Devils. So I was going there no matter what, and they were lucky enough I was lucky enough to get accepted. So like I said, it was kind of something always in the background, but it kind of just one day back in 2005, I was like, let's do this. And it worked out.
All right. Well, we really appreciate you being with us. So let's get into our topic today. We're talking about the 1031 exchange. First question, what is it?
That's a great question. Also, a 1031 exchange, also known as a like-kind exchange, is where you take your investment property and sell it and buy other investment property and defer the gains on that sale. So the way I like to look at it and the way this is set up, I like the name of this, Know the Rules. There's a lot of rules, and I'm sure we're going to get into most of them. And some of them are easy to understand and nuanced as they go on. But as the general scope, if you're doing investment properties correctly, you should be making money. Assets appreciate. you do not want to be paying those gains when you sell that piece of property. So I own an apartment complex. It's gone up $1 million. If I sold it without a 1031 like kind exchange, I would have to pay capital gains tax on that $1 million gain. With a 1031 exchange, you're allowed to essentially trade up into another investment property. And we'll get into the rules here shortly, where that $1 million capital gain doesn't have to be paid that year. In fact, it's deferred and added on to the property that you acquire. And as long as you hold that property, you don't have to pay capital gains or any gains on that initial sale that you got. So like I said, the basic concept is selling an investment property that you own already, upgrading to something else, and not worrying about what that gain is, and the IRS not being able to touch that gain until that second property is sold or dealt with in some other way.
So, well, actually, that raises an interesting question. So you've used the term deferred, and then you said if that second property is sold. So you can't just keep doing 1031 exchanges till you die?
No, you absolutely can. And I think there's strategies where wealthy people or any kind of real estate investors rely on these 1031 exchanges to essentially keep deferring, keep changing the properties. And ultimately, this is the end goal for some very wealthy individuals. And it seems kind of morbid, but when you die, your properties that you do own automatically from the government are given a stepped up basis to their fair market value to your heirs and designees. So in a perfect world, if you do everything correctly, you can start low, keep on buying additional properties, selling the old ones, moving up the scale. And then someday you'll be old enough, everyone passes away, death and taxes. But in this case, you only have to deal with death because taxes will be stepped up and removed from the entire final transaction there. So that, I think, is an estate planning goal that many real estate investors at least try to rely on. I don't know how well they're able to do that, timing death properly, but that is a tactic that you can use. And before I know the next question is coming, how often can you do a 1031 exchange? Technically forever. You can keep on upgrading, but you'll hear some advice out there that this is an investment property. You should try to hold it for a year or two, just so that you don't look like you're a flipper or someone that's just kind of doing this, doing it for like a for sale property. There is classifications under the tax law of holding something for an investment, which means 12 to 24 months or longer, versus holding something for sale, which is I'm buying this, doing something to it, and quickly trying to turn it around. If you're doing that more for sale transaction, the IRS does have the option of jumping in there and looking at you and saying, hey, are you really qualifying for the 1031 exchange? Again, one of the nuances, many rules, one of the nuances.
So go ahead, Sean. I see that you were going to ask.
So let's talk then about the taxes and the capital gains. So, and you mentioned a short-term hold as opposed to, say, a long-term hold. And we've all heard, short-term capital gains, long-term capital gains. Can you just kind of give us a basic primer on capital gains? What are they? What's the difference between long-term, short-term? What are you looking at generally on tax rates, those types of things?
Exactly. So a capital gain is defined as any increase in value on an investment. So you see them all the time in stocks, you see them all the time in real estate, whatever you hold for value and it increases in value. When you sell it, you have what's known as a gain on it. So if you buy something for $100,000, sell it for $125,000, everything else being equal, you have a $25,000 gain. That will be considered a capital gain. It was based upon the appreciation and value of the property over time. A capital gain is defined into two sections. There's a long-term capital gain, which is you held the property for more than 12 months. And there's a short-term capital gain, which means you hold it for 12 months or less. A long-term capital gain is taxed at, I believe it's 20%. That's the capital gains rate. That's what you would get and have to pay on. A short-term capital gain is taxed as ordinary income. So depending on your tax bracket, that could be as high as 37%, 32%, 24%. So a lot of people, knowing that preferred capital gain on a long-term gain is lower, will try to hold for that 1 year time period, the 20%. More nuances, and I think we're going to be getting into a lot of nuances here, is what is, there's depreciation recapture. I believe that's at a 20% rate. There's different types of assets out there. I think we may talk about 1231 assets or something to that regard. And everybody has different rules on what they are. Well, the IRS has different rules on what they are. But for the most part, when you're thinking of capital gains, that's what you have 95% of the time. A capital gain, 20% if it's long-term, ordinary income if it's short-term. Now, what happens if there's a loss? That's always the other end of the spectrum. You buy something and the market goes down. Well, capital losses are treated as they're treated as losses, and you're able to offset $3,000 of your ordinary income every year with your current capital loss. So if you buy something for $100,000, a year later you sell it, it's for a loss. You sold it for $97,000. You have a $3,000 loss. That $3,000 loss would then offset your income for that, your W-2 wages, your rental income, whatever flows through on your 1040 form. But do know that capital losses carry over. So you'll eventually get to use up all of your capital losses. If you have a $15,000 loss, you can use $3,000 a year for the next 5 years. Maybe the following year you have a capital gain, you can offset it. We're getting into the weeds now, but just know that capital losses are valuable, but they're limited in how you can use them.
And I'm going to get in the weeds because I'm just really curious actually about the capital losses and capital gains. Let's say that you had a capital loss of 15, you use 3,000 to offset your income, leaving you 12,000 left. The following year you sell something and you have a $12,000 capital gain. Can they completely offset each other, or are you stuck just using the 3,000 that year?
No, a capital loss, the technical rules, and we're in the weeds now. The technical rules are it offsets any kind of capital gains for the year plus $3,000 of ordinary income. Now, here's another tactic you can use. Capital losses can actually be carried back, a net operating loss, depending on how you do it. You can carry those back into years. So if you wanted to, this is 2023, you can maybe refile a 2022 tax return. This is getting into more net operating losses as opposed to capital losses, but there's a lot of tax strategies there that if you are generating losses from your business or your property, it's not just the straightforward, okay, let's just wait into the future until I can offset them. There's a lot of ways you can use them.
So Todd, what kind of properties qualify for a 1031 exchange?
That's a great question. So the way that the 1031 laws are written now, they used to be a lot more liberal back 10, 15 years ago, is it basically says it has to be an investment property. And most of the time, in fact, almost all the time, that means that it's real estate. It means that it's a piece of real estate that you're holding for an investment purpose. So what does that mean? That's anything from raw land all the way through the commercial skyrise, all the way through the industrial warehouse, residential, multifamily, whatever you want to do. But then the question that you'll always hear from your clients, what about my primary residence? What about my vacation home? What about my second home? Are those considered investment properties? The government will tell you no. They're pretty straightforward on that. But with tax practices, obviously consult with your CPA. There's ways to take your primary residence. There's ways to take your family vacation home and make it an investment property for a couple of years. You maybe don't want to do that. It requires you to move out. It requires you to find another primary location. It requires you to find, taking your vacation home that you're lucky enough to have and have strangers Airbnb in it for 2 years. But there are ways to change the qualification of your vacation home, let's say, into an investment property by renting it out, by making it available. So then you could take advantage of the 1031 exchange in a couple of years. And it's the same way on the flip side too. Can I take an investment property that I 1031 exchanged and then make it into my primary residence? The government's going to tell you no. But again, if you do it properly and you give yourself enough time, you can change investment properties into residential personal residences. It's difficult to do. It requires time. And like we'll learn with 1031 exchanges, it's so easy to break these rules and you're in trouble. So the point is you got to follow the rules. This, among anything, a lot of tax things are always rules oriented, but there's always a little bit of leeway here and there. A 1031 exchange is pretty straightforward under the case law. You must follow these rules. If you blow any of them, you're out. So, just be very careful. I think the general question was, what can be an investment property? Look at it as something that you're making rental income on, something that you're holding, that it appreciates in value, that you're not personally attached to. You're not living there. Your relatives aren't living there, third parties, related parties, those kind of things. Keep it separate, follow the rules, because these tax benefits are so great. You don't want to blow a rule just because of something that you're trying to finagle.
So let me ask you this. Let's say, and I know this is a case with a lot of people. Let's say I own 3 Airbnb rentals, 3 short-term rentals all over the country. And 99% of the time, unrelated individuals, third parties occupy it. But there's times where, it's open for a week and I decide, I'm going to go, stay in my short-term rental because I want to explore the city that it's in or whatever, right? I mean, it's there, it's free. Nobody's using it right now. Does that all of a sudden move it from, say, investment to like, you're hosed, you can't ever 1031 exchange it?
It doesn't. There is leeway under the law. I believe it's a couple weeks here and there every year. You're allowed to stay at your investment properties. You're allowed to have others stay at them. Just like what is considered an investment property. Well, you only have to rent it or something for so many weeks a year if it just remains unoccupied. So there are those weeks. I want to say it's 14, 20 days. Don't hold me to any of that. You got to look at the law, or I have to look at the law a little bit better. But when those questions come up, a good attorney will look at the law, know the exact answer, but do know there is a leeway there. Yes, I want to go stay at my New York penthouse that I'm lucky enough to own. So yeah, of course you're allowed to stay there for a week and you're not going to blow this exemption or this tax deferral tactic.
Now, I thought I heard you correctly, so correct me if I'm wrong, Todd, but it sounded like what qualifies as an investment property usually is real property, but doesn't necessarily have to be. Can a business qualify as a 1031 exchange or for a 1031 exchange?
It doesn't. It's mainly real property. It's mainly real estate. This is what it's built for. Under the old laws, there were aircraft, some kind of high-end equipment. I know those things are still in some kind of phase out period, but for the most part, you should think of it as real estate, land, buildings, apartment complexes, those type of things. And before we get too far, I think we just got to quick step back. So getting back to a 1031 exchange, the main rule that I want to make sure everyone gets out there is there are timelines for you to have to do these things. So I have an apartment complex. I decide I want to sell it. This is the key rule. You have 45 days from the date of sale to identify replacement properties, meaning the properties that you want to step up and step into. You have 45 days to do that. After that 45 days expires from the date of sale, so now you only have 135 days left, there's a 180-day timeline in which everything has to be completed from date of sale to closing on the new stepped up property. So the two timelines I want to make sure everyone realizes, there's a 180-day outside thing where the whole thing has to transact and be done. Within that time period, there's a 45-day period where you have to name the replacement property. So what does this look like from a form scale? What does this look like? What does the IRS want to see? So you sell a property. You now go to the IRS with a form. I believe it's a form 8824. And you write down, these are my replacement properties that I am interested in buying. And as soon as you submit that, you are locked into buying one of those replacement properties if you want your 1031 to successfully complete. So you got to do some planning ahead of time. You got to kind of know everyone that 45 days, I got, 2.5 months to figure this out, or a month and a half. I'm sorry. Days run by on you. And you got to make sure you have your replacement properties identified. There's rules out there on what can be, how do you do replacement properties? Most people do the standard rule of you select 3 and you go from those three. There's ways to get more properties in there as long as they're under certain values. We can get into that if we have time. But that is the execution process. And that's what I think is the key thing that everyone needs to know, is that this is a time-sensitive transaction, and you always want to step up in basis. You always want to buy something bigger, because that's the main pitfall, is if you don't use your entire gain, some of that comes back to you. And it's known as this word, and you'll see it on the internet. It's known as boot. And boot is a bad thing. Boot means that you didn't do your transaction correctly enough. That means that you have gains coming back to you. You will be paying taxes on those gains. So I'm hitting you with the fire hose right now. We'll take a step back, and we'll go from there.
Okay, well let's now I'm intrigued, because this seems like almost an impossible thing. But
Yeah.
even though people do it, so let's say I sell the property. I'm like, okay, great. I'm going to do a 1031 exchange. I have to identify three properties. I can't identify any more than that. Or can I?
Again, nuance of a rule. So the standard process is 3 replacement properties. There is a rule out there, a sub rule under that says you can identify as many properties as you want, as long as the total value of all those properties isn't greater than 200% of what you're selling. So I'm selling something for $750,000. I can designate as many properties as I want, up to 1.5 million, 2 times that amount. Separate thing, you can designate an unlimited number of properties or investments. And when I say investments, it means real property. We talked about that earlier. As long as you close on 95% of those. So those rules are, like I said, nuanced. You can backfall onto them, but most people just choose 3 properties because they know, hey, this is the one I'm targeting. This is the one I think I can easily get. Let me throw a couple backups, and bang, we go from there.
So what happens, and you're in a competitive market, competitive space, and you list these properties, you approach the sellers, you make offers, they want unreasonable terms, and all your transactions fall through. Are you just hosed? Like you're out?
You are. Your option then is don't sell your property, and wait for something else. But if you've already sold it,
I thought it's 45 days from the sale. So
you're done.
Could I fill that form out and put it in before I've sold my property?
You can do it simultaneously. You can actually do what's known as a reverse 1031, where you can actually identify the replacement properties and close on those first, and then do it in basically in reverse order, where as long as the buy and the sell happen within 180 days, it's okay to identify the properties before you sell your own. Again, it's that 45-day network. So if you identify your properties, you better sell your property within 45 days, and then you have 180 days to make that happen. So there are ways around that. And then let me just throw another thing out here. When 1031s were first done, many years ago in the tax world, it used to have to be a simultaneous exchange. And it used to have to be where the person that was buying and the person that was selling, you had to know each other and, basically almost swap properties. But now, because rules, and that was almost impossible to do, what we have now are known as intermediaries, where there's a trustee that will handle this and basically, take your property, put it in there. And that's one of the keys of a 1031 exchange, is you can never receive the proceeds from your sale. It always has to go to the intermediary. As soon as you touch your proceeds, if for any reason anything is sent to you, $50,000, hey, closing costs, bang, it went through you by accident because the check was written wrong. Boom, that's boot. You're in trouble. You're going to pay taxes on that. So you got to make sure everything goes through the intermediary. And a professional intermediary, and that's what I always suggest people to hire, they will have other options for you. There's real estate trusts out there. There's the Delaware statutory trusts where you can just buy into those. There's ways where if you don't have your replacement property identified, there's ways that you can substitute in, as long as they're part of your replacement properties, to get your money somewhere where it needs to go. Now, those aren't as advantageous if you're a real estate owner, want to control it, want to control your tenants, but just know there are ways to do 1031s through professionals where there's these other real estate investments that allow you to get 100% of your gains off of the books.
So, okay. So if say the 3 properties you've identified fall through, your intermediary could be like, okay, let's throw it into this trust deal for a year and start over, right?
Exactly. But make sure that trust deal is on your 45-day form that you submitted. So you're basically doing the 200% rule at that time.
Now, okay, well, that's good to know, because so let's say you're going to do a reverse 1031 exchange. So you fill out your form, you give it to the IRS, you're going to try to buy the property before you sell yours, and it all just falls apart.
Yeah.
It's done. And so can you then go back to the IRS and be like, all right, I'm out. I'm not doing a 1031 exchange. You hang out for another.
Yeah, exactly. Well, you have no taxable event. You never sold your property.
Okay. But can you do a new form at that point and identify
absolutely. 3 new? You got to restart the process, basically.
Right. Now, what if you're doing a non-reverse, a traditional 1031 exchange? You sell your property, you fill out that form, 45 days, let's say you're Johnny on the spot. 5 days after you sell your property, you submit the form and you start working up offers, and you're getting it. You're out there, you're getting up offers. And on the 40th day, you realize, I'm not going to be able to obtain any of these properties I've identified on day 40. Can you do a new form or fill out a new form?
I don't know 100%, but I believe so.
Oh, okay. So you could do a new form and say, okay, I'm going to make a run.
I think as long as you designate your properties and you leave yourself some wiggle room, you can redesignate new properties, but don't hold me to that. You're getting a little bit above my knowledge on that one. Right. I normally do the reverse ones. The ones that I've seen, people have things locked up. The designating the properties part is more of a nuance than it is the wild, wild west.
What about conditioned purchase contracts? So you haven't sold yours yet, but you're trying to lock up a property. So it's just conditioned to close. Your closing's conditioned upon your sale of your own property. That way.
Just remember, the days don't start until your property is sold. So as long as the conditions are met and you have a closing date, whatever date that is, you end up closing, that's when your timelines start doing the forward ones.
Now, having, right now we're kind of talking about having this process in place as we start. When you talk about facilitators or third parties or intermediaries, those just don't arrive on the scene. Those are things that you have to put in place. So it sounds to me like if you're going into a 1031 exchange, you don't want to have just sold your property, 45 days are now running, and you're like, okay, how do we get this started? How soon before that should you be really, realistically thinking about setting this up, and what do you need to do to start setting it up to have those facilities ready for this, assuming you get the go ahead on some of the properties you're going out?
Yeah. The transactions that I've seen, the intermediaries are already lined up. In fact, the intermediaries are involved with the escrows. They're involved with the sales brokers. They're the ones, because when your sale does close, remember, the money has to go somewhere. If that money ends up in your pocket somehow, a check is written to you, somehow an escrow is dispersed to you, you lost. The proceeds can never touch your human pockets. It can never touch your LLC's pockets. It can never touch anyone related to you pockets. It got to stay somewhere. They got to stay in trust. And that's why the intermediary is usually already lined up, so that the intermediary can take those proceeds and then disperse them to the property that you're going to buy.
So it sounds to me like in a perfect world, you're thinking about doing a 1031 exchange right about the same time you're interviewing agents to sell your property. Like it's part of the decision early on and is ready for this. It's not a last minute decision made after the sale.
Correct. And in fact, most people that do 1031s that I've been involved with, they're a 1031 king, they're buying the property knowing that, hey, in a year or two, I already got my eyes set on these other properties. And that's one thing that's great about a 1031 exchange is it's not like you have to just sell one property to do this. You can sell a gaggle of properties and, take all the money and mix it and buy, a larger something else, take a bunch of properties, combine them into one skyscraper, take one skyscraper, break it down into 30 Airbnbs. There's a lot of finagling on the numbers on each side to do it. The key though, and I think we've touched on this a little bit, is you got to make sure all of your proceeds go into the new purchase. So if you sold something for $1.2 million, you better be buying something for $1.3 million. And if you have mortgages on these things, you can't lose debt on the deal, meaning you can't, make yourself in a better position, have less debt. So if you're selling something with a $400,000 mortgage, you better be buying something with a $401,000 mortgage that you need to do it. Any of those differences where you're actually stepping down, you will have proceeds. And proceeds aren't the end of the world. They are called boot. I tried to make them scary, but just know, just because you get proceeds from it doesn't ruin your whole 1031 deal. You still get the 1031 benefit up until what those proceeds were given to you. So you may end up with a deal if things don't work out perfectly where $1 million was able to be deferred and 100,000, I'm gonna have to pay capital gains on that 100,000 or something like that. So the boot doesn't destroy the transaction. The boot is just what you have to pay taxes on.
So the boot will just come back to you as capital gains. And if it was under a year, it'll be regular income. If it was over a year, it'll be whatever. It'll be the 20%.
Most of the time, capital gains, it could be depreciation recapture. It could be something to that regard as well, depending on what your basis was in the property, the mortgages on it, the improvements done, and what you were buying.
Well, let's say then hypothetically that you have a landlord and they own, let's say, pretty decent sized multifamily building, and they're just tired of dealing with that. But they still want some level of cash flow every month. And so they decide they're going to sell the larger building. And let's say that they sold the larger building for $2 million. And their basis was $1 million. So they pocketed $1 million that would otherwise be subject to capital gains tax. And they're going to do a 1031 exchange, but they actually want to downgrade, right? And they want to buy a smaller, maybe a fourplex for 500,000. Can they do that and use $500,000, buy the fourplex, and then pay capital gains on the remaining 500,000?
Exactly. That's
Okay.
what would happen. They would defer. The way the numbers work out, just know if there's a big gap like that, the whole capital gain might be realized as boot. But if it was a smaller gap, there's, it's all a numbers game. So it's all taking your current basis, figuring out what what your capital gain would be. It's taking your proceeds. So the way that I look at it in my mind's eye is, if you're downgrading properties, meaning that, okay, I'm going to accept some capital gains I'm going to be taxed on. If you're going down 50%, you're not going to qualify for any tax deferral. But if you're going down maybe 25% to 15%, there's a way that you're probably going to defer some of it. If it's in that 10% range, maybe 10 to 15%, you'll probably get a good deferral greater than half. Again, it's all a numbers game, but you're exactly right. If you don't mind paying taxes on some of it, there's still a way to defer most of it.
Okay. Todd, are there limitations or restraints on the type of replacement property that is purchased or qualifies in a 1031 exchange?
Great question. No, as long as it's considered an investment property, there's wide leeway of what a 1031 exchange can be done. Raw property that you own can be exchanged for the skyscraper. The skyscraper can be exchanged for the residential, whatever it is, as long as it's an investment property, it will qualify as quote unquote like kind. Even though they're on different sides of the country, different, stratuses of the real estate world, it will be considered a like kind. And that's one more thing. This all has to be done within the United States. You can't be buying foreign properties. You got to be buying something within the United States, selling something within the United States in order to qualify for a 1031 exchange.
What about buying from a family member? If they have a great investment property, they want to sell it, you're going to pay fair market value. Can you use
Related party
CPA?
transactions are okay.
Yeah.
You just got to make
Okay.
sure it truly is, arm's length, and it's not too related. It's one thing to buy from an uncle versus buying from a spouse. But yes, as long as the capital gains will be recognized, you can use a 1031 exchange there. The only thing that I've seen out there that the IRS will crack down on is the intermediary. And most of the time people are hiring professional intermediaries anyway. The intermediary, the person that's holding your proceeds, the person that helps you with the forms, even, they can't be related to you. They can't be your attorney. They can't be your real estate broker. They can't be your uncle. Hopefully those professionals aren't any of those anyway. So that's who you go with.
So this all sounds complicated, and generally when it's complicated, it's expensive. What are the closing costs on a 1031 exchange? What are the costs that you have to pay to the mediator? What does this mean to the bottom line as far as, the cost of a 1031 exchange versus a traditional sell or purchase?
It is a cost, but I don't think it's extravagant. It's fair. I mean, you can shop around and find an intermediary that will do it for, I think what I've seen, I actually Googled it kind of preparing for this. I saw intermediaries out there that were charging in the low thousands. It wasn't that much. If you think about the taxes that you're going to be saving on this, I mean, $100,000 capital gain at 7% or even 20%, you're looking at 20 grand. So, I mean, it's definitely a small percentage of that. So, it's a cost of doing business is the way to look at it if you're trying to use this strategy. And I don't think anyone's going to complain, about that cost. It's not significant enough to ruin the transaction. In fact, it's rather insignificant in what I've seen.
Now, can I use the 1031 exchange funds to cover the intermediary fees as well as the other closing costs?
That's a great question. The amounts of your proceeds can be used for closing costs. It can be used for brokerage commissions. It can be used for everything as part of the sale. When you start trying to use it for other things, repairs on the property, buying the inventory that comes with the house, buying the furniture that's in it, that will be considered boot. Will the intermediaries fees be covered? I believe so. Yes, you can make that as part of the transaction. If not, I don't hold me to that because I was looking at it. I think it falls on the list of things that will qualify, that will allow you to.
Now, you mentioned earlier in an exchange, you can kind of pick and choose. It doesn't have to be a one-for-one exchange in terms of amount of properties. I could take one and exchange it for three if it's like kind and value. It sounds like. Can you do the same? Does it matter whether you're exchanging from, let's say, commercial to residential? Both were done for investment purposes, but maybe you'd been in the commercial game and you wanted to swap out a $2 million commercial facility into, a book of maybe residential properties that you found. Is there any limitation in doing that, or is it just look at the amount?
Yeah, it's basically the amounts. You want to make sure, like I said, to always step up in order to defer all your gains. So yeah, commercial to residential, residential to commercial to industrial, whatever you like. And it could be a mixture of that. It's not like you have to buy all residential. You can buy one commercial property and an industrial property. Whatever, the values are more important than the classification. Almost anything is considered a like-kind exchange under the rules.
Does the tax structure of the selling entity matter? Meaning, you can have an S corp, you can have a partnership taxation. Presumably, if it's investment, you have it into an LLC. Does that impact your ability to do a 1031 exchange?
It does not. The entity, the selling entity does not matter what it is. The buying entity doesn't matter what it is. The key, though, is that the selling entity's got to take possession of the new property. So if your LLC is selling the residential apartment complex, your LLC has to be the one buying the skyscraper next door. You can't be going from a property is sold in an LLC and then, oh my gosh, I want my incorporation on top of that to buy. It's always got to be the same entity. It has to be both the buyer and the seller of the transaction, or the seller and the buyer of the same transaction. And whether you're buying it from an individual, from someone's trust or whatever, perfectly fine.
So even if the entity is a disregarded entity, it's using my personal tax return, it's flowing through, onto my taxes, if you will. I don't even file tax return for the disregarded entity, right? It's just flowing all through to me. That same entity has to be the one to sell and buy, as opposed to maybe another disregarded entity that I form.
I think you're looking at my notes, because you get into a lot of the minutia there. If it is a disregarded entity, there is an exception where the individual could buy it. So if your LLC is a single member LLC, and the way that this comes up is when someone buys a residential house, the LLC is, 3501 North 32nd Street LLC. Right. Well, exactly right. 3501 doesn't now have to buy, 7501 North 32nd Street, as long as a single member LLC can be used, and created to do the transaction. You'll still qualify, because you're exactly right. The disregarded entity filters down to one individual. That one individual is considered the buyer, seller of the transaction. But if it's my partnership, if Fowler St. Clair wants to sell something, well, Fowler St. Clair better be the buyer as well. But based upon nuanced thing, based upon how partnerships are set up or LLCs are set up, if one member wants to break away and 1031 their one tenant in common interest in the property, there's ways to do that. The LLC breaks apart, for that one transaction. A 32% interest in the skyscraper is sold by member A. Member A then goes out and buys a warehouse with that. LLC, if allowed by the LLC, has a new co-tenant, has a new co-owner. They may not be happy with it, but member is able to break away and do a 1031 exchange of their interest in whatever property that LLC owned. That's very complicated. I would say get an attorney involved on that one. Get an attorney involved on any of this. Get an intermediary, but you're really, it's allowed, but make sure you're following the rules.
Well, actually, what you're saying is very important, because if you're jumping into the investment world, especially the buy and hold world, there are going to be times where you probably over the years are going to want to do a 1031 exchange, and you may not want to buy your new property in the same state that you sold your own property, because you can cross state lines. You can go buy on the East Coast when the property you sold is on the West Coast, different states, right? And so what a lot of people do is they say, okay, well, what state am I buying the property in? Oh, my original property, I'm going to buy it in, say, California, right? I'm going to go buy it in California. And so you're like, well, I need a California LLC. And so you go and you form an LLC in California, and then you sell the California property. You're like, oh, I'm going to go buy a property in Arizona. Well, then in Arizona, you have to buy that property in this California LLC that you set up, right?
If you have other members in your LLC, yes.
Yeah.
And everyone agrees to it. Yes, correct.
Yeah. Yeah. I mean, you would have to then, but you may be like, well, wait a minute. I know from experience, California has a lot of fees for LLCs and stuff, right? And so in Arizona, our LLC's $85. You form it, you forget it. You never have to do anything else. There's no annual fee. There's no annual filings, whatever. But all of a sudden you're like, well, now I got to keep this California LLC going and do my annual filings, pay whatever to hold now an Arizona property when I otherwise wouldn't have to do that. So it almost makes sense to research, well, if you're going to do a partnership thing, okay, well, where do we want this LLC to be out of? Where's the most cost-effective place to start it up? And then if we have to, we can domesticate it in the state where we buy the original property, knowing that if we ever want to swap it, we can just end the domestication in the, arduous state that's so difficult or whatever, and not have to pay those fees, and move and domesticate it in the state that we want to. But I think it takes some, foresight and planning to say, okay, where do I want to have this LLC? Even if I'm buying a property in another state where I'm not forming it, I don't want to have to form it in a state that's difficult. And honestly, there's a lot of states that outside of Arizona, in my view, that I've experienced that are very difficult. And you have to do annual filings and annual fees. And it's a real pain to upkeep your LLC in those states. And I would say probably a good half of the states are like that, outside of Arizona, where it's really simple.
Yeah. And the way I answer that is, I think you hit on it, Sean, is it's levels. Are you the professional real estate investor that's going to be doing a lot of these things that, I know I'm going to have these sales. I know what's going on here, so that you can plan ahead accordingly. I think they're already on top of that. It's the mom and pops. It's the people that, that we come in contact with that are, probably these are things that we haven't thought about or will need to think about. So yeah, the more you can throw out there at the beginning and making it, hey, you may want to be doing this one day, or, I want to use this strategy someday. Let me make sure I got all my ducks in a row now. You're exactly right. I mean, the one thing that I would say to kind of help that, and, maybe you have to wait a year or two, but make a transfer into an LLC that's related to you somehow other way, so that you can set up for this like kind exchange later on. That's how I would kind of get around that pitfall, is doing an early transfer to solve it later.
Yeah, and I think if you're going from identical partnership to identical partnership, as long as it's not an S corp, I don't think you have to pay any type of capital gains or tax to just go from one partnership to another. If it's identical, everything's the same. So you could, and if you did some planning and say, okay, look, let's plan on our 1031 exchange next year. Let's, we don't want to have an LLC formed in this state because their rules are difficult and their fees are high. Then you could do that. So that's a good idea. So even if you didn't do it right at the beginning, you might be able to, rearrange it later on.
One final question for you, Todd. What, in your estimation, what is the most common pitfall that you see with 1031 exchanges, and what consequence flows from that if somebody messes it up?
Well, the greatest pitfall I see, this is my accountant talking, is not doing them. That's the greatest pitfall, and paying taxes. But when it comes to actually, you're in the weeds, you're going through them, it's just planning, making sure that you have your replacement properties designated, making sure you're able to get this deal done, making sure that you're not leaving yourself, with your shorts down, trying to scramble because other things happen or you're having to pay more money. I mean, you never want taxes to waive, the transaction. You want the taxes to be, fall in line with the transaction. So if you're doing a transaction just for tax purposes because you had to do it, that's the problem. So just make sure prior planning. What is it? The 5 Ps. I always like throwing out slogans when I'm on your show. The 5 Ps, what? Prior planning prevents poor performance, right? So just follow that.
All right. Well, Todd, thank you so much for being with us. Tell our listeners how they can find and connect with you.
Yeah, absolutely. So the CPAattorney.com, www.thecpaattorney.com. Contact at the CPA Attorney is my best email address. 209-789-5610 is my best phone number. Like I said, I help people out in Arizona and in California. And thank you again.
All right. Thanks so much, Todd. Looking forward to doing it with you again. Have a good one. All right. With that, everybody, that is our show. Make sure to join us for The Collective tomorrow at 5 p.m. and next week and every week at 10 a.m. on Tuesdays. We'll see you next week.
Have a good day, everyone.